Hey, welcome back to the channel. I'm Doug, the Retirement Guy. Two new ETF funds that go head-to-head, ULTI and KYLD. Who can replace ULTY? They're all built on the similar platforms, and we'll explain them today. But before we do, we want to do a shout out to all of our Patreon supporters and all of our YouTube subscribers. If you're not a subscriber, don't be afraid to hit that subscribe button, hit that bell notification. You don't want to miss a single one of our videos. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. This information is for educational and entertainment purposes only. The information put into this is not financial advice. I am not a financial advisor. If you need financial advice, always contact a professional. So the problem with ULTY, well, let's take a look at the background and success. YieldMax's actively managed ETF is designed for weekly income. It uses synthetic cover call strategies on volatile U.S. stocks. It did a great job and grew from 250 million up to 3.5 million in assets. It established itself as a prominent high-income fund. Now, the assets under management have dropped over $1 billion in only 30 days. It's down to 2.45 billion. The NAV erosion that has happened dramatically on ULTY. So significant NAV erosion over 22% from July's high. It decline began around March when the strategy changed. Investors experienced a net loss despite high incomes. So let's introduce from RexShares the RexShares Income Max Option Strategy ETF, ULTI. So Rex came up with a program. They just introduced this, so there's no real track history. It only started trading maybe a day, 2 days max. RexShares, we know them for a lot of their different weekly income ETFs that they've put out. The strategy is dramatically adjust a mix of put and call positions on volatile U.S. stocks. Their distribution is potentially is going to be on a weekly basis, and they're saying early November is that they will start the process. They've already introduced a lot of information that we're going to share with you today. One thing is the lower expense ratio, and they're going from ULTY's 1.4 down to 1.25 for ULTI. Now, the features of it is going to be the enhanced weekly income, the potential for higher income distribution, actively managed, and downside mitigation, protection against the market volatility. If this comes true, there could be a potential for some very valuable points to it. So let's take a look at two things that's already out, and we'll start on the left-hand side, and that is their portfolio. And you can see some of the stuff on there matches a lot of stuff that ULTY has been covering. So you got Sunrun, you got Upstart, you got Gemini Space Station. So there's a lot of things that have the volatility that you look for in a fund like this. Now, October 31st is the latest information that we had. Their NAV starting off is going to be $25.84. Okay. Their closing price on the very first day of selling was down 1 penny. So they're already starting off with $5.1 million in fund assets, $200,000 or 200,000 shares. And number of holdings, they're sitting with 102 different holdings. Now, our next fund we're going to talk with comes out of Curve. This is their first weekly ETF fund, and they're going to be KYLD. The benefits or potential benefits from the Curve High Income ETF. They offer reoccurring income stream to shareholders. So there's a nice potential that you'll get a weekly income from them. Gain and exposure to a portfolio of high growth securities. This is where it's different. They're looking for higher growth securities than just generating high income off of volatility. They also use a tax advantage. Option premiums may not be initially taxed, therefore the potential of offsetting short-term tax liabilities. Sounds to me that they are planning on using an ROC program, which we're very familiar with, and kicking the can down the road, which will put us into long-term tax programs. Now, taking a look a little deeper in what we found so far, that they're using option strategy for reoccurring income. Their expense ratio is 1.16, so that will be the lowest out of the 3 different funds. Their holding strategy, the portfolio of high growth securities, which makes me excited with that potential, that if that's going to be higher growth, that this thing will probably have a higher upside. Exposure to gold and silver mining ETFs, another potential positive, and a 10.38% cash position. That one's got me questioning and interested in what is exactly going to happen with that. So they're giving you the potential of reoccurring income. They're giving that potential of growth exposure. We've talked about that tax advantage, which I believe will be ROC. Do not hold me to that, but that's what I'm looking at, is going to be an ROC type program. And the risk management, a strategy for protection, which is what a lot of people have lost focus on with ULTY. So when I was able to break down more information here, we started looking at the holdings that they have. And in their holdings, we're seeing more common names that we're used to. Robinhood, Broadcom. We've seen the VanEck gold miners out there. That's been out there for a while. So we're definitely seeing some positives in the holding side of it. When we take a look at the snapshot of what they have out there, they really have not put out what they have investment-wise or net assets to work with yet. So again, it's early in the game. It's just another one that really came out announcing that they were going after that ULTY market and seeing if this one will pull through. So when we do the comparisons, really all we have right now is to compare is the strategies and the expense ratios. As we said before, 1.4% for ULTY, 1.25 for the REX shares program, and Curve comes in at 1.16. The core strategies is a synthetic covered call on volatile U.S. stocks to generate that potential weekly income from ULTY. REX is going to use an options on high volatility U.S. stocks for that potential of weekly income with downside mitigation. So it's kind of giving you a little bit potential of a protection of the dropping off. So we probably will not see as much downside on ULTI than we would with ULTY. And in Curve KYLD, there are options on high growth securities for potential of reoccurring income with the potential of tax advantages. So 3 different strategies, 2 of them very close to each other, but fixing the problems that ULTY had, which is what REX has done. Curve is coming after you with a whole different program, similar to what ULTY is doing, but doing it with high growth and giving you tax protection. So I take a look a little different here and laid it out a little bit differently for you. Is the same information as ULTY has that synthetic covered call, which you can look at basically 70% of their portfolio is designed around that high volatility U.S. stock. It's focusing on extreme volatility. Now, REX ULTI gives you a little bit different. Okay, they have a 19% cash position. So they're holding a little bit more cash. And that is basically to do what they need to do down the road of buying new funds, buying different funds, and working accordingly. A smaller portion now in the green will give you 65% is into the options of volatility. So you can see they're only 5% off of what ULTY has done. And they've done, like I said, they've done specific names that they're working with to try to generate that higher volatility. And then when you take a look at Curve, this is more the balanced approach. And I believe the people who have bought into ULTY trying to recover from things, I think KYLD is the potential of looking better to them than anything else. The potential of reoccurring income with the tax advantages. They're using 50% of the funds into high growth securities like Broadcom, Intel, AMD. They're holding 10% in a cash position. Now that 10% in cash position is to generate additional income. Where they put it is the question I have. I don't know if they're just going to put in the T-bills and so on, that's going to collect us 3 to 4% potentially. We're waiting to see. The other part of it is they're putting into the other, basically is going to be 40% of the fund will be going into the income generating side of it. So you have high growth on 50%, and then you have income generating. This sounds very similar to what I would say from REX Shares 50/50 programs that they've done in select pieces. But they're doing this in the broader area with multiple different funds. So it'll be very interesting to see how these things perform, and we will definitely keep you updated and bring you the track history of each and every one of these when we get more data coming into us. So the performance insights, when we look at REX shares, we talked about that. Their balanced program that they've had out there, REX shares, NVIDIA's had a very decent total return at 57%. Their Tesla's 45%. Their coin is around 15%. Their MicroStrategies is horrible, down 31%. And the YieldMax ULTY has had that 18% growth. So Rex knows what to do, potentially has the ability to do some good things, as you see with NVIDIA and Tesla. So we're really waiting to see that the company, again, has the potential of doing the right thing. Can they do it with this fund? So they've had some strong underlying assets with NVIDIA and Tesla generating those big yields of 57 and 45% respectively. They've had a weak underlying asset with MicroStrategies. So when you're only picking one fund, you got to pick the right fund. And unfortunately, MicroStrategies, as many of us know, has been very, very weak. So when they get into a balanced strategy with income and for potential income generation and poor underlying performance, you can just pull out some decent numbers. So we're positive that these guys are going to have an opportunity. Now the REX Shares ETFs to the ULT underlying performance. Again, each one of them, they've shown the potential that they can outdo it again. They've shown it across the board to make sure that they have the potential to set themselves up for success. So my real takeaways, if you're considering switching from ULTY, which I'm getting a ton of reports out there that people are making the switches, are making change. They don't always have a place to go to. This is going to give you a transition to ULTI or KYLD to basically due to ULTY's NAV drop off. Now, if you're waiting and observing the performance, monitoring the initial trade of Rex ULTI and Curves KYLD, allow time to understand the real world behavior of these funds. I am in that category. I am one who will be waiting to see what ULTI and KYLD actually do. You know from the channel, I'm a person who has no fear of waiting 3 months, 6 months for them to show me and for them to produce some solid information. I'm not just going to jump because it was a YouTube show. It was not something on YouTube. I want to see the performance, which is what we try to bring you here on Doug the Retirement Guy's channel. Now, underlying assets growth, this is a big one for me, focusing on underlying assets growth potential. What is the potential of these guys having some actual real true growth? If we're going to look at what's the potential of growth, what's the potential of income? If they can produce a decent, solid income and give us some decent growth, I think we have a win-win. But if we're going to find out again that we're losing on the growth side but gaining on the income side, what have we really done? So monitoring the performance before investing is huge, and we have to make sure that we know what these funds are doing, what these funds have the potential of doing, and where they're going to go from. So hopefully this gives you guys some direction of what's coming into the future and what you can plan for. I know both of these are already out trading, so we'll be redoing this in a very short period of time to give you the actual true hardcore numbers, and again, giving you some potential of what they are out there for. So conclusion, guys, I'm holding tight. In my portfolio, I'm just sitting tight. I sold off my ULTY, as I've told you before. But I'm waiting to see if ULTI is going to be the game winner, or is it going to be KYLD. They both have potential alternatives to the ULTY, addressing their NAV issue and also their income issue. So as we talked about replacement potential, they are definitely something to look into as they've tried to clone what they were doing and fixing the errors. The strategy focuses that considering the expense ratios are definitely much less, and evaluating the holdings approach. Monitoring is track the initial trading, observe the performance, and make sure that this fits into your portfolio. Hopefully this helped you out, you guys, and let us know.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug the Retirement Guy.